You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everybody. Welcome to this episode of the Capital Table. Really excited on this episode to start a three-part series with our good friend Paul Marino with Sadis and Goldberg. And we're going to cover over this, kind of the state of affairs that we're living in the M&A world, or as we've kind of coined it, stuck for good, or perhaps for a little while longer in the middle, as we look at the difficulty of closing deals in the middle market today. So again, excited to have everybody join us. Steve Brady, partner and market leader of transaction advisory with Withum. And Paul, thanks for joining the Capital Table.
Steve, thank you so much for having me. I truly appreciate it. I look forward to our discussions. My name is Paul Marino. I'm a partner at Sadis Goldberg. We are a law firm here in the city. I run our corporate and M&A group. Most of our clients are middle market clients. And for the purpose of this conversation, just want to put this to the folks who are listening. Everybody defines middle market a little bit differently. I think like Citibank defines it as $1 billion to $2 or $3 billion. But here we're just going to say a middle market and lower middle market is transactions in the size of typically between 10 million and 500 million.
Yeah, and certainly a similar market space that both our firms are operating in and our listeners. So excited to explore these issues, Paul, in what we would both say is the true middle market.
Yeah, for sure. Well, I mean, that's again, in a transactional context, it's an interesting space because, as private equity has matured more and more, it has the amount of private equity funds that operate in the middle market may have, potentially increased, but the amount of middle market private equity funds has actually decreased. What do I mean by that? The amount of funds that are 200 to 300 million, 100 million, and the big reason for that, Steve, is because, most of the LPs are institutional LPs have not only check size, but concentration limits. So if you have a check size of $500 or $50 million and a 10% concentration limit, that, even though I'm an attorney, I can do that math. That's about 500 million. And, so generally speaking, they're looking for funds 750 to $1 billion, which is why, Steve, the rise of the independent sponsor has really taken off, because they can cover that space and cover that deal size.
Yeah, certainly the proliferation, I'll use that term, of the independent sponsor community, which not the focus of this podcast, but certainly something you and I have talked a lot about over time. I mean, we're both seeing that increase. And I mean, you're absolutely right. That's one of the macro factors driving the independent sponsors and also those that have been successful in those former category of middle market funds that are finding it harder to raise funds. That a lot of my clients certainly seeing it easier to do it on their own and being very successful at it. So,
for sure.
Great part of the middle market private equity community. And today for our audience, I mean, I think, we're going to focus on, to start this discussion, key economic challenges and market specific challenges. But before we, dive too much into that, again, I think, you're looking at the overview of the economic climate and looking at inflation, interest rates, the geopolitical situation we're in right now. And, and I think just to emphasize what Paul has said a little bit ago, certainly the importance of middle market deals and driving economic growth, and the market we're seeing as active, but in a large point with the activity increasing and where we're at right now, again, going back to our our title for this series that, it's difficult to get deals across the line. So again, Paul, excited to dive into this. We'll talk about, for our audience, again, key economic challenges and some of the market specific challenges today. But as we look forward to episodes 2 and 3, we'll get into some more specific things on deal financing and geopolitical, et cetera. But Paul, let's start with the key economic challenges. And certainly I think one of the things that's been a 2024 and late 2023 dynamic is rising interest rates.
Yeah, so it's an interesting dynamic, in as much as you had the Fed rise rates to 500 bips and basically, the shortest period of time ever, right? So you had this interest rate rise, which really stalled out the market, and, in hopes of tamping down inflation. And inflation is a huge killer. Now, I'm here to tell you that I think that interest rates played a huge role in slowing down the upper ends of the market. So, you figure that the Fortune 100 companies, even Fortune 500 companies, where so many things come into play, including, the carry trade or, FX exchange, the currency exchange, et cetera. The middle market really doesn't have that, right? And especially the middle market we deal at 500 million and under. I mean, I don't see it being as interest rate sensitive, but what the rise of interest rates has done is chilled the market, which is what the Fed wanted. And it's created a dynamic that, that has tamped down the urgency to get deals done. And let me explain to you. I'm a big believer in not necessarily across the board, but in this particular, especially for transactions, in trickle down, right? Trickle down economics here. And what does that mean? That means that when bigger companies are doing deals and they're doing deals at a greater volume, right? It all starts to kind of trickle down and comes down into the middle market, because what creates is a sense of urgency or alacrity, which is a great SAT word. And this alacrity, right, starts to permeate and people start to believe that there's an urgency to get a deal done. And this sentiment, irrespective of what people want to, believe or otherwise, sentiment controls. We're all human, and we're so subject to the way we feel about things. You feel great today, you might go out and go out and buy something for yourself, or you're feeling great weather, and a nice spring day, right? And your first really nice one, maybe you take your wife out for dinner or whatever it is, but you feel great about it, so you're going to go out and do something. You're not feeling great, and you generally don't want to do anything. And Steve, one thing I want to point out to support that is the recent sentiment polls, and I wrote an article about this in September. The recent sentiment polls, right direction, wrong direction of the U.S., is 71% of U.S. citizens feel that the U.S. is heading in the wrong direction. So that's a big number. And I think when that number starts to come down and people start feeling better, that will spur deal activity. Now, again, when interest rates go down, that will trigger larger firms likely to do deals. And that trigger will have a downward effect or pressure down effect and trickle down to the middle market.
Yeah, and I think analogous to that, and that's a great overview of that, the impact of starting with the interest rate increases, but also the feeling good in the middle market M&A community. I know what we've seen, a lot of people waiting, meaning entrepreneurs waiting to go to market because private equity is sitting on the sidelines, has been. We're starting to see that activity pick up, albeit early stages of that. So I think it goes hand in hand with exactly what you're saying, Paul. The sentiment when private equity says, hey, let's take our portfolio companies to market. It's time to sell. They're confident they'll get the valuation that they deserve. That's going to help fuel activity, and it does trickle down, to use that phrase. So.
Yeah. So to that extent, and again, I like to just keep it like very for me, it's always, KISS, keep it simple, stupid. And I think if people out there listening think about it in terms of bid-ask spread, and the bid-ask spread, where you've had the buyer, right? The buyer has now said, hey, look, this is what your company is worth. It was worth 10x maybe 3 years ago, but now we feel due to inflation, due to sales, forecasting, et cetera, that you're really worth 8x. And a seller is still believing that it's 10x, right? That seller hasn't had that come to Jesus moment where they're really like, okay, maybe this is really the valuation. I think, that spread has remained, that gap has remained wide. And, once it starts to normalize and the seller believes that, hey, you know what, it probably is only worth 9.5 or 8. And the buyers are now willing to start hitting that, and they're afraid that somebody else might, then you're going to see deal activity. And think about it like this, Steve, and we joke about it here all the time. It's in folks who know me, I love golf, and you have like these T-box valuations, right? So you're in the T-box and your buddy is talking about he just sold his company and he sold it for, again, 10x. And there's two ways you could go. You could think, well, you know what? I just got a bid out on mine. It's 8x. I'm never selling. I want a 10x. Or, you know what? I should start go to market right now. And things are hot. Maybe I can get 11x. And when people think that they can get the 11x number, that things are hot, that's when they're really going to sell. Because generally speaking, you don't sell into a slide, right? Nobody's going to catch it from one night.
Right. Absolutely. So I guess rounding out our discussion on the economic challenges, certainly you touched on a little bit. Certainly the inflationary pressures have impacted deals. I mean, what are some of the other dynamics you're seeing with your clients, Paul, on the impact of inflation?
Well, I mean, trying to readjust depending on what you're doing, right? So services, the service industry, healthcare's got huge inflationary, irrespective of inflation itself, right? There's a constant number, like an 8% increase year over year in healthcare. But, taking that aside, I think that if you're in manufacturing or if you're in any type of consumable good or otherwise, there's a huge issue as it relates to shipping, cost of goods shipped, or that could be oil, that could be shipping from overseas to here. And then of course you have, food costs. The increase in food costs has been huge. So I think that pricing dynamic where a company may not have that type of elasticity in their pricing model, right? Where they can't just start to really push out on the outer edges of it. It has really eaten into their margin. And, as you're eating into that margin, there's only two ways you could really combat that. You could increase prices or cut headcount. And it's hard to cut headcount and probably will be for the next, 10 or 15 years just due to demographics. So then, your margins are getting compressed. And that's what, I think that's really what's spooking some buyers at the market right now.
Well, and also I think, and I had conversation with one of our investment banking friends the other day, and they had a deal with an industrial company, and that company was not able to or not willing to, not to comment on which one it is, raise their prices in the inflationary environment they were impacted with. So that basically stalled that particular deal out a year. So, again, certainly to your point, a lot of impact on what's coming to market and certainly the valuation. And with that, I guess, again, you touched on your T-box analogy of valuation, which really does kind of sum it up. But, other thoughts on the uncertainty around valuation and some of the specific items driving that, other than the T-box analogy, which, again, I think kind of sums it up at the end of the day.
Yeah, I think that, I think it, for all intent and purpose, valuations are as much of an art as they are a science. You know that, right? And so it's really what somebody's willing to pay. Now, when you get down to it, it's your comps. It's hard to make comps off of a period like 2 or 3 years ago where there was so much pent up demand. So my feeling is that valuations are probably normalizing out. They are probably getting into a glide path that is likely in line with traditional baseline valuations. So what do I mean by that? I mean, dude, things are super hot. They cooled off a bit. You're probably now coming into an era where you're going to see valuations, more in line to what they traditionally were out of business, software, and maybe, 10 to 14 times EBITDA, something like that. And, and then kind of moving along in these traditional path. With that said, it doesn't matter until people really want to buy something, and they're out there, until that point happens, you're just not going to see a lot of activity, and when does that happen? If I knew that, I'd be a very wealthy guy, but I could tell you, I do think that, and I wrote this again in an article we published just recently. I do think that once kind of sentiment flips, you can tell that by two things. One is, people are going to conferences more, so those are, buyers are going to conferences more. And there's that, once they feel like there's just some type of FOMO, like a fear of missing out, right? That's one area. And then and then your second area, in that is, are banks lending, right? And or non-bank banks, are they lending? Are they out there starting to really feel like, hey man, I need to start to get more of my deal book filled. And once those two things happen, I do think that you'll see way more deals, as simple as that might seem.
Right. Yeah. So I guess with that kind of, again, for our audience, macro view of some of the economic challenges, let's drill down into a couple market specific challenges, and, really two to talk about here. One, certainly supply chain issues. And I know that in the last, 18, maybe it's 24 months now, conversations with private equity firms that focus on industrials and other manufacturer distribution. The issues with supply chain have been kind of mind-boggling in a lot of very specific situations. And your thoughts on that?
Well, look, I tell you, for middle market, lower middle market, wherever you are, you're going to be affected by supply chain issues. They had that potential strike on the East Coast. If that would have happened, and dragged out, that would have been a huge issue for everyone. I think most of the bananas in the east of the Mississippi come in from Baltimore, I believe. And that's one of those ports there. And anyhow, I only bring that up because it affects anything and everything. So,
right.
I think supply chain issues are interesting, are out there. Where we ran a just-in-time, system for most of my adult life. Now it's just in case. So, people are, and again, that also impacts profitability, right? So if you start stocking your warehouse with goods or materials that you think you may need, that 100% impacts you, because now you're warehousing stuff that you generally wouldn't have otherwise, which means that you have to pay money. So a lot of that, plays into part. And I don't want to be forward-looking or political, but I will say, Trump was just in Chicago yesterday at the, and talking with the head of Bloomberg's. He's their editor-in-chief, I guess, of Bloomberg itself, of their media content. And there was an interview, and it was interesting because Trump is so pro-tariff, which goes totally against most, traditional Republicans, in as much as that, they were free trade. Now, again, this isn't political. It's just saying that if tariffs are going to be a big part of the next administration, and I think even, if Trump won, or even if Kamala Harris wins, I would bet that the tariffs will play a part there as well. That in and of itself presents a lot of problems for supply chains, because then all of a sudden, are you buying goods at a higher price until those goods can be made in the U.S. or Mexico or Canada, from NAFTA? But Steve, think about that. Are you going to be able to push those higher costs down to your consumer?
Right.
And if so, how much? And how much is that? And if you can't, how does that impact your valuation?
Well, I think those two issues, the tariffs and what you mentioned, the beginning of that commentary, just around, the disruption in the supply chain. I know we've seen it from buyer behavior and the diligence process around these deals. And again, in the big sense, we're talking about why it's difficult to get deals done now. But buyers are looking at that supplier base in a way they never did before, and that supply chain in ways they never did before. And it's either meant very often slowing down deals or stopping deals because the buyers get nervous that some key part of the supply chain might have big issues going forward, and they're not going to write the big check for a company and then start operating and not being able to operate the business. So it's a huge issue. And again, the second big topic, just kind of around the market specific challenges we're going to talk about in this episode, consumer confidence, consumer preferences, and how that's shifting. What are you saying with your clients in terms of how that's impacting deals and in the market?
Well, first of all, that's a great question in as much as this. When you think about it in terms of what consumers are affected, or what investors are thinking about or looking at, in the middle market, lower middle market, a big investment group of family offices. And there are way more family offices now than there were 2 years ago. And 2 years ago, there were way more than there were 2 years before that, and et cetera. So, which is great, because, we want Americans to keep getting wealthier and wealthier. But their mindset of what they're looking for has changed. So, for instance, what we see more now, where families are looking at are QSRs, quick service restaurants, buying blocks of QSRs, whether they're Dunkin' Donuts, et cetera. And why? Because you can more or less earmark a rate of return on it, and you're not taking. It's not a single, maybe it's a double, but it's certainly not a home run on your investment. Right? So you're not getting a 10-bagger on something but you're getting a great rate of return, and they do carry a nice multiple with them if you get the right operators. So I think that the investor is kind of looking at where the landscape is, and that investor, if they have a lot of money in their family office, they may be looking for different things. For other folks that are, let's say, high net worth guys, their preference might be software or another type of software related, maybe where it's AI or an AI component of it, where they can get a much higher multiple or rate of return on their money. What's interesting to me was really how a lot of this really impacts, valuation and do outdated business models. For example, do online media, which is really, and you could see this just happened in Viacom for CBS, in CBS, where that was at one point such a property to own. It's now not necessarily bad. It still cash flows great, but it doesn't have the cachet or carries a valuation that it once did. And I think that you're seeing that, across the board. Accounting firms, right? Professional service firms. Investors are looking at that. Why? Because they're thinking about in terms of great cash on cash return year over year, and then and then aggregating more of these accounting firms together where they can start to really build out certain business lines and get a consistent rate of return. And to me, that's an interesting model. So
yeah, those touching on some great topics there, and certainly again, for our audience, I think we got a great start to talking about this topic of why it's difficult to get deals done in the environment today. Look forward to episode 2, and please tune in for that. We're going to focus on that episode on the deal market and issues around debt financing, impact of geopolitical events, and then, a really important challenge today, and that's human capital. And your last example there, professional services firms, Paul, obviously that's square and center with some of the dynamics around human capital in the world and the business world we're in today, and how that's impacting deals. So
certainly,
thanks for joining us.
Steve, when your number one asset goes home every night, right? I mean, it's a very difficult thing to put your finger on, right? So you have to make sure that those people are going to be there the next morning.
Yeah, exactly. And certainly I've had clients over the years, having done this for many years, that used to live by the mantra, I don't want to invest in a business where the assets walk out the door at night. But
Correct.
we're seeing that shift in today's
Yeah.
world. So thanks a lot, Paul. Look
All right.
forward to continuing the conversation.
Thanks, Steve. Really appreciate you.
Take care.
Bye-bye.
You've been listening to the Capital Table. For more information, please visit withum.com. Thank you for listening.